Hello YouTube, welcome to another video with the Mango method. This is a video in the Mango Musings. So it's just myself on a camera talking about a topic and hopefully it gives you a bit of insight. And often these topics are either modeling related or financial analysis or some of my banking background, or just kind of lessons that I've learned throughout the time and just my own sort of opinion on certain things. One thing that sort of I really want to address is just the thinking that business owners have. And look, it's not a frustration. I understand why they do it. And it is something I hope to assist or educate our clients or just create more broad awareness of the matter. And this just relates to that sort of concept of cash is king. As a previous banker, I'm a big proponent that cash is important in a business. And we used to say at the bank, profit doesn't pay your loan, cash pays your loan. So look, I am the first one to accept that cash is crucial, and understanding cash in your business is crucial, but that can be taken too far. I see a lot of discussion around, cash flow is the only thing to care about. You only care about cash flow. You only care about cash flow statements and stuff like that. It is important, and this is a topic that, I'll discuss another time, but there is a crucial thing that there are multiple financial statements. There's a profit and loss, there's a balance sheet, and there's a cash flow statement. Look, there's also an equity statement, but if we stick to these are crucial and they all work together. Now, technically the cash flow statement sort of just reconciles the profit and loss and the balance sheet. Yes, you can create a direct cash flow statement straight out of, the cash line items, but often seen in financial modeling and analysis, often the cash flow statement is purely just a reconciliation between the P&L and the balance sheet. The important thing I want to talk about is cash is very important, but you also need to understand the fundamentals of your business. So that's why I always suggest that people look at the profit and loss. They understand the different levels of the profit and loss statement. You'll find as you get into sort of more mature or larger businesses or enterprise organizations, P&L focus is a key thing. Yes, the larger, cash is not as important potentially, and there's a lot more room and buffer. But the key thing to understand is, in the long run, the P&L wins out. So if the shape of your P&L is right, so if there's profitability at all levels, if you have strong gross margins, if you have really solid EBITDA margins, profitability dictates cash in the long term. So if a business is profitable, it will overall a lot of working capital movements, a lot of different balance sheet compositions in the long run. If you have a strong P&L in the long run, this wins out. Which is why it's important from a strategic perspective, the long run P&L view and strategies around ensuring that the P&L view is obtainable, is measurable, obtainable, smart, budgetable, can be broken down from a long-term strategy into, shorter periods. Like it's crucial to get that P&L right, because it will eventuate and the cash outcomes of that will eventuate. Now, in the short term, absolutely, balance sheets are critical, and balance sheets are what actually dictate what happens to cash. And time after time, I've seen people neglect one or the other. Actually, to be honest, oftentimes I've seen people neglect both, but they'll more often understand what a P&L is than what a balance sheet is. But it is also very crucial to understand a balance sheet. Actually, I once had an educator, Chinmay. He's on LinkedIn. He's a great finance educator. Really simplifies complex topics. And I'm just going to borrow this from him. But he once described financials as money in, money out, money that should have come in, or money that should have gone out. And I love this description because it really simplifies the concept of it all. That, at the end of it, there's one of four things. Money that came in, cash receipts, money that should have come in, accounts receivables or some kind of accruals, money that went out, cash payments. It doesn't matter if it's to vendors, contractors, it's money gone out. or money that should have gone out. So payables, accruals, so on, debt, loan payments, payable outstandings, whatever, all these different things. It's one of these four things. So, if you can kind of get a good grasp and understanding of all of these concepts by understanding a profit and loss, understanding what your margins are, that plays out long run. If we go back to the balance sheet, understanding the balance sheet gives you that short-term framing of cash. And when we do things like 13-week cash flows, we're actually being quite detailed with how the balance sheet works. So how do you manage accounts receivables? How do you manage specific, creditors? Who's getting paid at what timing? What are the due dates? So on. Like, all of that is just detailed working capital balance sheet management. But if you ever play around with the financial model, you kind of find that if you have a point in time forecast that you've made, once you roll the model, often what you find is the long run position. So if you look out 3 years from now, or a year, even 12 months, once you're past the working capital cycle, if you look out a year, you'll find that all the working capital stuff that happens goes out in the wash, and the forecasts in those future periods will not change unless your P&L changes. Well, okay, if your balance sheet in terms of fixed asset changes, then that also impacts, but that also impacts your P&L as well. So the raw outcome is, unless you change the P&L, you're not really changing the outcome of your cash position in the long run. So that's why I keep coming across requests for 50-week weekly cash flows or full year weekly cash flows. And my comment is often, yeah, we can do it. We physically can do it. There's no problem with that. But should you? Like, what's the value in that? Because again, if we take a step back, what are we doing in the weekly cash flows? We're looking at the detail weekly cycles. And in some cases, we're even going out to the detail of daily, because, whether it's a Tuesday or a Wednesday, it might make the difference between Amex payments being late, which you don't want to be late on Amex payments, or large payments being late where you don't want to, because you haven't got the daily control. But that weekly view is very short term. It's just trying to make tactical decisions, tactical action plans around what you need to do to ensure that cash balances are maintained, or you're kept within your limits, or payments are made on time. You can only shift things around. It doesn't change the overall scenario of your business. So for example, if I do a 52-week cash flow on a weekly basis, and I look out 50 weeks from now, what accounts receivables can I influence? What accounts payables can I influence? So we often have this debate about weekly cash flow in the long run, like long-term weekly cash flows, long-term, monthly. Like, just deal with that in your three-way financial model. So that's just something to understand, because when you're in your three-way model, the key component there that you're trying to work through is the strategy around the P&L. Because like I said, in the long run, the P&L has overwhelming influence over cash balances. The balance sheet, look, like I said, unless you're getting new funding, unless you're getting, you're spending more on CapEx, the overall impact is largely contained within that P&L. So if there's a cash shortfall 50 weeks from now, playing around in the weeks is not going to help you unless you've got the strategic overview of the P&L long-term correct. So this is where I come back to that sort of original point of running, like, having cash is king. Yes, cash is important, but being a profitable business eventuates in generating cash for the business. So this is where it's crucial. Like, just make sure that the shape of the P&L is right, and that plays out in the long run. Make sure your margins are correct. You've got that gross margin right. That plays out in the long run. Gross margin has as much to do with, there's 7 cash flow drivers. Gross margin is one of them. So OPEX is one of them. Like, just controlling these P&L line items is so crucial. I had someone explain to me, I think it was a virtual CFO by the name of Remco Marcellus, very knowledgeable person. He once said to me that within a budget, you can't control revenue. Revenue is nothing you can do. You can influence revenue, more marketing spend, proper sales processes, better fulfillment, all of that stuff can improve and influence your revenue. But something you do have complete control over is your expenses. So again, if you have a proper view to your P&L, you can understand what the long-term impact of decisions will be on your P&L. And just take it as a further analogy, and I take it back to my banking days. And for most bankers, there's a reason bankers don't look at a monthly set of financials as a rule of thumb, especially for simpler transactions, because it is more important what a person does or what a business does year to year, and how they manage a budget, how they manage spend, because a revenue that you're expecting this year, last year's probably as good a reference as you'll get. But the thing that you can fully control is the expenditure and managing the expenses. So and this is probably something to talk about in another video, but running your business via the bank account, fraught with danger. And I see this time and again, where influxes of cash always creates, I'm a business owner and I understand, but an influx of cash often creates a euphoria that you all of a sudden have cash to play with in the business. But the problem is sometimes that cash is spoken for. So it is so important to have a longer term view, understand, again back to Chinmay's example, understand what's coming in, what's going out, what should be coming in, what should be going out, because what's come in might be tied into something that should be going out in 3 months from now. So and that's why people struggle with BAS time, and that's why time and again we get requests to do more detailed modeling during quarter ends, because BAS time is coming. We didn't realize we had this GST bill, or we didn't realize we had all these bills due. So just a quick Mango Musings just around cash. Cash is king, cash is important, but there's context to that. Thanks again for tuning in for another video with the Mango Method.